Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10 FX Strategy. I'll be your host once again today. And once again, we're going to take a run through major currencies. It's been another very interesting week, certainly a much more maybe cautious week. Oil prices rising here, that having significant impacts on major currencies, in particular a stronger dollar against where we were at this time last week. And to discuss this and a lot of other drivers, both in the past week and in the week to come, I'm happy to be joined once again by Paul Robson, who co-heads G10 FX Strategy with me, sitting over in London. Paul, thank you so much for joining.
Well, as ever, Brian, a pleasure to be here. Like you say, it feels like FX markets being dominated by the Middle East once again. Focus very much on central bank reaction functions and pretty much everyone trying to wonder where the oil price is going. Central banks just globally seem to be very focused on any sort of persistence in inflation from this energy price shock, which in itself is proving to be a little bit more persistent. And it was just interesting looking at market pricing just before jumping on the call. And then all of a sudden, we've got markets are pricing in hikes from a whole range of central banks come September. It feels like once markets have got through the holiday period, we're going to come back a bit of a bang in terms of policy potential policy announcements and whether we get divergence and repricing. I think that obviously will matter for currencies. Given that focus for FX markets on around, I just wanted to start there this week, if you don't mind, just what your latest thoughts are about what we're seeing in the Middle East and what kind of impact you think it's going to have on the dollar.
Yeah, so I mean, it certainly feels to me that if for the last couple of weeks, I think the sort of word, the posture of the market was one of cautious optimism, both on oil prices and on the conflict. That, you'll have heard, if you're a frequent listener to this podcast, you'll have heard me say that the market has generally priced towards the worst of the conflict being behind us. I feel like that was sort of the posture of the market, really, since the initial ceasefire in mid-April. And then markets were only validated with those expectations heading into the MOU in June. The most recent escalation in conflict, the president saying the ceasefire is over, the escalation in the conflict, and more recently, the scale up in rhetoric with the Houthis joining in terms of trying to blockade the Red Sea, Saudi ships in the Red Sea, attacks on ships in the Strait of Hormuz, and most recently, President Trump threatening to respond to future attacks with attacks on Iranian infrastructure, specifically bridges and power plants. I think what we might be seeing now is maybe a crack in that assumption that the worst is now behind us. And that's led to higher oil prices. We're still well off the levels that we had seen at the peak of the crisis before the initial ceasefire. But what we are nevertheless seeing is that interest rates, particularly in the front end of the curve, across economies, are reaching those elevated levels. So oil prices are not, at their highs, but rates certainly are. And that, of course, reflects not only tightening that has already happened by a number of central banks, but as you mentioned, Paul, expectations for future tightening, that markets now are priced, positioned, feel pretty confident that further tightening is coming in a lot of different economies. And, I think it speaks to the uncertainty underpinning these markets that it was only a few weeks ago that it felt like there was a bit more clarity, a bit more certainty. The market could start to price towards maybe future inflation outcomes being quite a bit more friendly to policymakers, in part because lower oil prices will be putting downward pressure on headline CPI. But you've started to maybe remove some of that clarity, pick up some of that uncertainty. And with it, we've seen rates across jurisdictions move back higher in the front end. The U.S. has been a relative leader rather than a laggard in that move. And as a result, part of this move has been higher dollar versus the baseline. Now, it's notable that, if you look at something like equity markets, that today's session, as we speak on Thursday, you've seen some downside in equities, but for the better part of the last 2 weeks, it feels like equities have been almost a lagging indicator when it comes to higher oil prices, maybe feeding higher rates. Normally, you sort of associated that with like a risk-off sort of posture. That one you haven't necessarily seen as much, and FX volatility in general is still quite low. That could change if oil prices are really sort of heading towards ever higher levels. But it's still notable that it's not all one story. I think still in FX markets, there's still probably room for differentiation in central bank responses, differentiation in terms of how energy prices impact growth as well, and those do matter for currency markets. So we talked a little bit already about how central banks are sort of being forced to posture with a suddenly much worse energy outlook. And it feels like, at least among major economies, the ECB decision today, as we record on Thursday, is really the first one out of the gate. Anything worth highlighting there in terms of their decision and how that's impacting the euro?
Yeah, there was very little impact on the euro from the announcement itself and Lagarde's press conference. I think, as we spoke about last week, we talked about a hawkish hold from the ECB, and I think that's what we got, talking about risks around inflation still skewed to the upside. And as with all central banks, it's about the duration and intensity of the energy price shock. And as we move through the months, it's clear that the shock is longer and maybe not as intensive as we could have feared. But it's interesting, like you note, that the oil price has moved steadily higher over the past week, and I think central banks would have been probably hoping by now that the oil price was coming lower. For central banks who worry about inflation expectations becoming de-anchored, and especially for the ECB, who had policy rates really quite low, even if you factor in that the economy is probably in a difficult situation, but a different situation than it was in 2020. Higher rates might be needed, and markets have moved to price in recent weeks a hike in September, and I don't think anything in today's various parts and announcements from the ECB really would dissuade markets from that. So balance of risk probably in favour of higher rates come the end of the summer, but that's already priced, so there was no reason for the euro to react. It wasn't all hawkish. There was one line about not yet seeing any second round effects, and this is obviously what central banks are worried about. As we know, energy price shocks are ultimately deflationary as long as inflation expectations remain anchored. So it feels like, on balance, the ECB will be looking, if nothing changes. And guidance is heavily oil dependent. We quite often talk about data, don't we? And the oil price will drive the data, and it will drive inflation and growth. But ultimately, it's really important where the oil price goes, and that's the key takeaway, I think, from today's meeting.
One thing that really stuck out to me as I was listening to you just now, Paul, is our Euro area economist, Giovanni Zanni, in his preview of the ECB, I think he put it really well, which is that the ECB is almost held hostage by geopolitical events, that it almost feels like your expectations around the next ECB move is very dependent on your spot estimate of where oil prices or where oil prices are at the time of the meeting. And I doubt the ECB is the only one that's sort of in that same camp. But to that exact point, may be difficult for the market to take much away from the ECB when they, like the rest of us, are probably very heavily dependent on where oil prices are in terms of the actual driving. Even if we can have a glean down the line that, these developments are not good for growth. That scales differently across economies, but they like a lot of others, I feel like, are paralyzed and in this sort of watching and waiting mode with oil prices. Do you want to turn to the Bank of England? They also have a meeting next week. What are you thinking there? What do you think is the latest for the Bank of England?
Well, I think for that meeting, like markets have priced, no change in the policy rate at that particular meeting. We do get the whole suite of things. We get the minutes statement, and we get a monetary policy report. Maybe the monetary policy report is an opportunity for some on the Monetary Policy Committee just to tweak their views on the policy path. But again, the Bank of England is in this situation where they're trying to hold off tightening policy, watching the data, watching the pass-through. Governor Bailey recently was saying that inflation, if it wasn't for the energy price shock, would be broadly at target. Now that is true, but there's also been government policy announcements over the past year to chip away at inflation as well. So it's not all about underlying inflation pressures in the UK economy. And as ever, it just leaves people with the vote count to see whether markets are right to continue to price a 25 basis point hike from the Bank of England come that September round of meetings I mentioned a few moments ago. Our economists, in their words, actually have got off the fence and think there'll be a vote for 6-3 in favour of unchanged rates. Maybe Catherine Mann joins Peel and Green in voting for a hike at this meeting. And if they're right, they feel that on balance, the next move in rates from the Bank of England is likely to be a hike, but not until November. If we were to get a 5-4, maybe Lombardelli join those three other dissenters, then you'd be a little bit more confident that it's coming in that September meeting, and especially if they get signs of second round effects. So we were watching that. We haven't really had a lot since the last policy meeting. Data have been in line. We've had a few speeches, but for us here at NatWest, it's the fact that nominal GDP levels just don't seem to be consistent with inflation coming back down to target. It's something we think that people miss. Generated inflation, service sector inflation still running well above target at just over 3.5%. So tighter monetary policy at some point. But as with the ECB, it's whether the tightening comes a little bit earlier in September versus November doesn't really matter. It's the overall tightening, I think, over the next sort of 6 months. And their markets have got about 55 basis points of tightening. The economists here at NatWest think 2 hikes, so 50 in total, so not a lot. But sequencing can matter. But as with the ECB, we're talking about, it's all going to be about the oil price, I think.
I want to turn now back to politics, because now we do have a new prime minister in the UK. What do we get from the new prime minister, cabinet appointments, and how is that feeding into your thinking on sterling, and how maybe the markets are thinking about sterling after this period of resilience? We've noticed the currency maybe a bit of an underperformer this week. How are you feeling about politics here with a changing of the guard?
Yeah, as you say, the currency has held up relatively well over the last couple of months. It did underperform this week. Maybe worries over the politics and fiscal policy just weighed a little bit. Whether the move higher in sterling just got a little bit ahead of itself. There's been lots of talk about M&A and buyouts in local media, and if that's coming from abroad, maybe that just supported the currency a little bit more than markets expected, and we've just sort of retraced. I mean, in terms of the events this week, obviously the outcome of the leadership election and then Prime Minister announcement, no surprises there. Chancellor of the Exchequer, John Healey, a little bit of surprise, but we would caution about focusing on personalities and really about just the fundamental positions of fiscal policy in the UK. There's lots of arse and wants on the public purse, and trying to finance those wants is what the focus is going to be, we suspect. And that's going to build into the autumn budget. We get the party conference season in September as well, and we'll get a little bit more meat on the bone about how various policy shifts are going to be funded. There were a couple of announcements about VAT on electricity demand, cuts in business rates, stable £2 bus fares, but really it's about where the money is coming from, and there'll be a lot of difficult choices, we suspect. And I think the key theme from now all the way into the end of the year will be the conversation the government has with financial markets about if any changes are coming, whether they are the right changes. And as we've highlighted in the past, the marginal buyer for the debt that government is going to be issuing is international investors, which can invest anywhere. And if they don't agree with the balance of risks, then you could get increased volatility for the currency. So we said last week we thought that it was probably as good as it's going to get for the currency through the summer, and I think the market reaction we've seen this week leans that way. But in terms of maybe it's time to move away from Europe's sort of central bank meetings, and we've also got the Fed next week. It's interesting that markets have equally continue to price more hawkish outcomes from the Fed. Just wondering how you see next week's meeting.
Yeah, next week's meeting is an interesting one because it feels like we're not going to get a ton from the Fed to validate market pricing one way or the other. If you think back to the June meeting, the press conference was very interesting because Warsh himself was a bit of an unknown commodity. It was his first time as chair. We didn't really know what the guidance would look like. We didn't really know what the communication suite would look like. Coming into the July press conference, I think we have a better idea now just from the passage of time. We've now had several instances of speeches from the new chair, including at Sintra most recently. We now have a very firm view that Warsh is against giving the kind of forward guidance that I think over time we've all become accustomed to. Additionally, we're not going to get the dot plot this time around. We won't get the summary of economic projections. We won't get the projections of the Fed funds rate. And if you recall, it was those projections, the dot plot, which was the big driver of the hawkish assessment of that meeting. That at the June meeting, sort of call it the recap of the meeting, maybe the summary of the meeting was the big surprise was that the rank and file members in the dot plot were much more hawkish. And that was really the big driver of a very hawkish response. At this upcoming meeting, we're going to have the FOMC statement and we're going to have Warsh's press conference. As I look through the FOMC statement, which is shorter under Warsh, as he put it in the June press conference, more factually based rather than guidance based or opinion based, I don't see a lot in that statement that needs to change. Similarly, I think the message from the press conference is going to be generally devoid of guidance. I wouldn't be surprised if Warsh kind of repeats what he said at his semi-annual testimony recently before Congress when he said, hey, mission's not accomplished on inflation, even with a couple of really good CPIs. And so I just wonder that if we're only going to get the statement, which is basically unchanged, and going to get a press conference without a lot of forward-looking guidance, how much should we be expecting this decision to really move the needle for markets if we assume, as we do, that the policy rate will be left unchanged? Market pricing actually has a pretty solid chance of a rate hike at next week's meeting priced in. We don't believe a rate hike is necessary or appropriate at this point. We think that the dual downside surprises in core CPI and core PPI, how those feed into the core PCE deflator, have probably taken a bit of some urgency away from the need to hike rates. And so we ourselves don't expect a rate hike at the July meeting. We also don't think they're going to hike at the September meeting, which is actually currently fully priced by the markets. As you sort of referenced, Paul, most markets are very highly priced for rate hikes by a lot of different central banks coming out of the summer. That's in part because we do expect some further progress on core inflation as we move through the summer months. And so we think that the urgency to hike rates is going to come down over time based on the data. But I think the reality is that for the dollar and for the market, that if last week's inflation data was incrementally positive in terms of inflation coming down, very good news on inflation, this week's higher oil price moves in the other direction and it sort of erodes, it chips away at some of that certainty. And we know that some FOMC participants are already a bit chomping at the bit to potentially hike to counter those risks and potential risks coming from inflation, whether it be to inflation due to AI build out and other drivers such as a stable employment market. So the one notable thing that might be new in this decision from the Fed is how many dissents do we get? So if we assume that the policy rate will be left unchanged, the more dissents we get, the more contentious we know that decision was. Our count of the dissents at this meeting, we think there are going to be two. If we get more than two versus less than two, that might give you a sense at how urgent some FOMC participants felt that a rate hike is needed near term. So I think that's probably the one big, maybe let's call it informative piece that we could get from this meeting. But for the most part, I think it's going to be. I think the Fed is going to let the market sort of continue to move in its own way. And force the market to make assumptions about its reaction function rather than Borsch trying to handhold the market and push greater clarity on their reaction function. Again, in our outlook, because we have core inflation continuing to move lower over the coming months, we don't think a rate hike is going to be needed. But that extra confidence in inflation could be offset or counteracted if oil prices continue to move up. And we, like the rest of the market, are all going to be forced to be relying very heavily on the data here.
Yeah, that all sounds very fair. Like you say, watching the data balance between inflation and the real economy and the labour market, but overlaying that on the impact of energy prices and like you say, something that we're not particularly used to, a lack of guidance from the primary central bank that sort of anchors everything else. For me, it definitely feels like we're going to get back from the summer period, and September's going to look pretty interesting because something's going to have to break, isn't it, in terms of those market pricing, we feel. The BOJ, we've also got them next week. For me, it feels like Japan is one of those areas where it's essential watching, both in terms of the policy rate, changes in terms of domestic legislation on savings, those kind of things, and the persistent weakness of the yen and volatility in the bond market, and whether you have the tail wagging the dog, which often seems to be the case when we come in London and a quick glance at what's been happening over in Japan to set us up for the day. So where are you on the Bank of Japan meeting next week?
I think you summarized it really well there, which is Japan is one of these economies that really has, I would call it, an outsized influence on global markets that are outside of its own purview, in part because of decades of excess savings being recycled out into other economies, and how changes in approach to local assets versus foreign assets could really move the needle, both for the foreign assets they hold and maybe are going to be reducing, and for and for their local markets as well. We talked about that quite a bit last week, Paul, where there was this discussion of whether local pensions could consider shifting their asset holdings more towards local markets. That's the kind of thing that over a longer term trajectory, if executed, could be quite significant, because FX at the end of the day is a flow product. You mentioned foreign investors and their willingness to buy assets at certain yield levels when you talked about the UK earlier, but that is the case for all global economies. And for Japanese investors in particular, because they have such large external positions, their approach to their holdings of international assets versus local ones is obviously really important for markets. You mentioned as well on fiscal policy, changes in fiscal policy, still very important, still very much in focus in Japan. That the Takaichi government is pursuing an expansionary fiscal policy. If anything, over the past 12 months, the push in terms of fiscal policy expansion has probably gotten even larger, simply because of developments on the ground. That higher oil prices have increased the urgency to maybe try and offset some of that pain onto consumers with fiscal policy. Also, the U.S.-Iran situation has, put a greater spotlight on Japanese defense spending. And so even relative to where we were at the onset of the Takaichi administration, it feels like the pressure to push fiscal policy in a more stimulative direction has gotten even larger. And I think the markets continue to question whether Takaichi can deliver on all of these different these different priorities without ultimately increasing the debt load for JGBs. And I think the market is clearly trying to find that clearing price. One of the things that we think about what could support the yen, which has been under persistent downward pressure. And one of the things we keep pointing to as a source of downside for the currency is that their fiscal monetary mix is still incredibly stimulative in absolute terms, and then even in relative terms when you look at monetary policy. That as fiscal policy becomes much more stimulative, monetary policy continues to move at a relatively cautious pace. And we, like the consensus, expect no change in Bank of Japan policy at their meeting next week. We think about the things that could potentially change the attitudes towards the yen. One would be a big change in the way that markets assess supply and demand of local assets, as in, hey, if local pensions and local investors are going to be buying more of these assets, buying less international assets, that could create a positive simply by less rotation of funds outside of Japan and keeping more of that money at home, that excess savings at home. Another one would be a significant change in the monetary policy outlook. And to that extent, we would note that there were some media stories this week about the BOJ being potentially willing to speed up their pace of tightening. I think in both the case of the pension story and the Bank of Japan story, I think the markets have taken a we'll believe it when we see it type approach, which is that these are the kinds of things that, if executed, could make a big difference for the currency because, from a carry perspective, the yen still is among the laggards in terms of interest rates, and that makes it very expensive to hold the currency, makes it attractive as a funder for risk trades still. And, as we look across the risk spectrum in currency world, I was just looking at currency returns, spot returns since the onset of the US-Iran war. Several of the high yielders in emerging markets have actually performed pretty well. The Mexican peso is basically flat to the dollar since the onset of the war, with obviously some volatility. And, as those higher yielding currencies continue to perform, that's going to encourage this carry seeking behavior, and volatility remains low, and that also encourages the carry seeking behavior. And so all of this is to say that the Bank of Japan speeding up the pace of tightening, if that were delivered, could be a significant positive for the currency. We just don't think it's particularly likely in the near term that the Bank of Japan has continued to slow play the tightening cycle. They have what I think is legitimate concerns around growth that come with a combination of factors, most obviously oil and related shortages and concerns around how that impacts manufacturing. They'll probably also consider whether a significantly faster pace of tightening could have impacts on their equity market, and maybe that feeds into lower business confidence, which could feed into weaker growth. And so I think there's reasons to remain cautious with this idea that the Bank of Japan might materially speed up tightening. I don't think that's something that'll be delivered next week by any stretch. But I'll make one last point on Japan before we close. It does feel like that the way officials have been trying to signal to markets, if you assume, like I do, that the BOJ story was maybe a bit of a plant, this idea that they might be tightening faster, it appears that Japan officials are starting to consider more closely what kinds of fundamental changes could create a more lasting source of strength for the currency. So it really could come from changes in investor allocations and a much different BOJ policy relative to its peers. Those are two things that I think, if delivered, could be quite significant in terms of offsetting some of this downward pressure that we've seen pretty consistently on the yen. You almost wonder if this maybe a bit of a greater focus on some of these more durable sources of demand for the currency might be a tacit signal that maybe they're a bit less willing to intervene to provide temporary support. So we know that FX interventions are really only a one-time source of positivity for the currency. If the market assumes, as we do in this case, that interventions are not going to be, repeated frequently, as in they're not going to be intervening every single day. We've had a couple of experiences now where the MOF has intervened, and we see a very large rally in the yen initially that is quickly sold into, and so I think officials might be thinking that intervention at this point might not be worth the cost of intervention, And maybe they're acknowledging that when they start to talk about, discuss, float to the market ideas to strengthen the currency that may be a bit more durable, more lasting than simply one-time intervention. So super interesting as we think about the currency being under this pressure, which I think is still appropriate with oil prices higher, markets are pricing tightening everywhere. The Bank of Japan is still slow playing. It certainly feels like officials are talking more actively about what kinds of steps might be needed fundamentally to strengthen the currency. What remains to be seen is if those are actually going to be delivered on and how quickly they'll be delivered on, because in the meantime, it feels like this currency might continue to see downside, especially if the Bank of Japan and MOF don't step in to try and stem that downside with intervention. So we've covered quite a bit of ground. Paul, thanks so much for joining. And to our listeners, thanks for listening. If you enjoyed the podcast, please consider giving it a like and also subscribing so you can get our latest content the moment it's released. Thanks very much.